Welcome to Indianomics. The Reserve Bank is proposing to liberalise rules governing financing mergers and acquisitions. Currently, companies don't get bank loans, nor can they raise foreign loans to do acquisitions. These restrictions are going to end soon. Companies will soon be allowed to tap bank loans and foreign loans to finance acquisition, but there's more. Foreign loans can also be used to buy real estate, purchase and development. That's not allowed now. Also, banks can lend more against REITs, units of REITs and InvITs, and also without any limit, they can lend against debt securities, listed debt. Companies can also raise much short-term foreign loans. Originally, it was 5 to 10 years. Now, ECBs can be raised for 3 years. What's the impact of all these huge changes? Will there be a flood of M&As, especially in industries like, say, cement, textiles, where there's fragmented capacity? Will dollars flow into Indian real estate, make real estate expensive for Indians? And will dollars flow in per se? Today on Indianomics, I have 3 experts to discuss these. Renuka, Ramnath, founder and CEO at Multiples, Sriniwasan, managing director at Kotak Alternative Asset Managers, and Rahul, Saraf, India head of investment banking at Citi. Gentlemen and Renuka, thank you very much indeed for your time. Renuka, starting with you, since you have spearheaded so many companies into the market, is there going to be a spate of M&As?
No, I would look at it as a reform which will have extremely positive long-term impact. Nothing can change overnight. What India needs is enormous debt coming in for the kind of growth that we have planned. CRISIL has estimated about 120 lakh crore debt that corporate India need in the next 5 to 7 years. So this reform will really play into that need extremely effectively. The other thing is that large corporates in India denied access to global capital on an even platform like their global peers, right? We are building companies here in India of global scale, global relevance, competing in the global market.
No, we could raise for raising capacity, but they could not raise to buy someone else's capacity.
Yeah, but ECB, there were other restrictions on the borrowing. It was not a level playing field. So I find the reform in the ECB guidelines extremely comprehensive. So it helps large corporates to get into a level playing field, and it helps small corporates to borrow now for M&A activity. Okay. Third, I think we should remember that in India, we had no mechanism to unlock the amount of value that is sitting in equity. Today, there is roughly $7 trillion by value between listed and unlisted put together of equity. We still have, India is a very fragmented market. You know, if you look at average market cap per company, we are at billion, and the next highest is China at 2 billion and US at 15 billion. Okay. So we are an extremely fragmented corporate, which brings with it a lot of inefficiency, and especially in the going forward global situation, these companies cannot compete and survive. So M&A consolidation is a must rather than a desire for us to go to that growth, keep the jobs, and move progressively rather than see a demise of a lot of companies around us. And I think this reform will definitely hugely facilitate it. So I expect to see the change over the next 2 to 3 years, because companies will have to make up their minds and look at consolidation as a serious value unlocking mechanism. But it is an excellent move. Any which direction you read this reform, it just exhilarates me and enhances the confidence of India achieving that 7 to 8% growth and becoming the 3rd largest economy in the world.
No, certainly, huge financial muscle given to corporates, or at least, when the rules are finalized. Srini, your first thoughts on the ECB rules? But I also wanted to know about real estate. That was a sacred cow because, land becomes expensive for an Indian buyer. Do you see money rushing in? Because it's, I would think, a very lucrative business.
First of all, if you look at the entire package that RBI has put out for the banking industry as well as, M&A financing, the summary that you mentioned, I am most excited about it. And as we were discussing just before the show, this is the 1992 moment for the credit markets in India. Okay. 1992 was when foreign investors were permitted into the equity
It was the
markets in
equity
India.
moment.
Right. And, within a couple of years thereafter, SEBI had actually come up with this, what we now know as free pricing of IPOs. Otherwise, a quaint little department called the Controller of Capital Issues used to decide at what price a company can do an IPO.
Yeah.
So in one stroke, RBI has opened up ECBs in terms of what is the end use that you can use it for, in terms of the pricing that you can, price it. It is linked to market conditions. And most importantly, in terms of who can actually provide ECB loans. If you look at the draft of what they have put out, it could be anybody who can provide an ECB loan.
Earlier, like my uncle living abroad can give it.
Exactly.
It says any resident abroad.
Any resident abroad can provide an ECB loan. So this is a great moment for ghar wapasi of all our dollars.
Okay. Yeah, especially since it shows more growth.
Absolutely. But what it also does for the banking industry, and I think as far as the banks are concerned in India, they've done two things. They have unleashed the banks in terms of the kind of reforms that they can operate as a conglomerate. And I think many banks which operate as conglomerates in multiple facets of financial services will find it so much easier to do business.
Yeah, overlapping rule restriction
it's
is
fantastic.
gone.
That is one. Secondly, they've also, kindle the animal spirits of the banks which have an overseas presence, because the ECB regulation provide the overseas branches of banks also to participate in this whole financing market. So it's not just, you've opened up the credit markets for everybody else. You also have an opportunity to provide this credit. And if, as Renuka said, if M&A financing is going to be a big play and which grabbed the headlines, M&A financing can be done by domestic banks, both rupee and foreign currency. It is a very interesting play of, what could potentially play out with regard to the credit markets.
We don't know that BOB has one of the largest number of
Absolutely.
Foreign branches.
Exactly.
I think, now it will be appreciated.
Yeah.
Rahul, your thoughts. First of all, you're also addressing dollar investors among our viewers. Is there, did you tap any of the foreign FPI in your conversations? Did you get a sense that money is waiting to come?
I think if we step back and say, okay, there are three types of M&A. You have inbound investments, so global guys coming and buying in India. Again, there's no change really that dollar was getting, that offshore financing was getting done. Then there was India outbound, where Indian corporates could borrow offshore as well. There was no restriction there.
Yeah.
I think the level playing field that Renuka talked about, where the Indian strategics now have the opportunity to tap the bank financing and do the acquisition. What were they doing earlier? They were taking private credit, NBFC financing, mutual fund financing. All of that was 100 to 200 to 250 basis points expensive. If you look at just from a corporate finance perspective, the math, it allows the Indian strategics to be at least 10 to 15% more competitive now compared to a foreign corporate or a private equity who was relying on offshore financing. So that's a big cushion.
Big gap that is...
that has got bridged, yes.
Okay.
So I think that's interesting. And then, of course, the end-use restrictions on ECB, I think that allows both the tenor as well as the end-use, allows more diversity in terms of financing options. So all in all, very welcome.
You expect dollars to come in?
Expect dollars to come in for sure, 100%. Yes.
Okay, but before I take my first break, something which stock market investors will want to know, where will consolidation come first? Do you see it in, say, paints, cement, textiles? What is the first thought that comes to the mind?
I would say manufacturing,
Okay.
definitely. And I think family-owned businesses. We see a lot of activity in families wanting to kind of move forward by leaving the businesses either with private equity owners or strategics.
And we're already seeing that, right?
We are seeing, the recent transaction multiples did. VIP Industries is, standout example being a listed company.
Okay.
So there will be, I think, wherever there is family-owned business, right? This fragmented ownership, dilution issues for family, changing their mental framework from being a controlling shareholder to a minority shareholder because you want to be a large conglomerate. All of that is going to be very complicated. Okay. I think the right method they would see as working well for them and markets would be to consolidate.
Fair enough. Okay, so there are some equity ideas also coming over here. Banks with foreign branches are going to be at an advantage. As well, fragmented industries are going to see a great deal of consolidation. For those of you who want to do the equity math, that's the clue. We have to take a quick break. We'll continue our conversation with our experts. For Bazaar viewers, it will be Chartbusters. You will get to hear the whole show after market hours.